in trade, and it follows what the rest of the world is doing. Just get the intraday of the Nifty if we can for a moment, and then get the heat map up on the screen, and you will see what I'm trying to say. Pain at the broader of the spectrum, even more so, in the metals even more so, but from the lows maybe marginally higher, but really nothing convincing. The US markets may be off again from the lows of the day because Nasdaq is not down. Nasdaq 100 futures are not down 5% currently. They're still down 3.5%. So therefore, there is no taking away the fact that the world markets are in a bit of a tizzy, and we are no different. And for whatever it's worth, I'll pull up the heat map. But there is, well, not much talking about, save for a few names which are defensives, and that's essentially the same set of 6 names, if you will, which are kind of moving around in the green and staying higher. But otherwise, I mean, just look at the cuts that have come into businesses and stocks. I mean, just for the metal stocks to get punished the way they have, upstream oil to get punished 6% as well. It is bloodbath across the screen, and I fear we may not be at the end of it, but who's to say that? Tamanna, broader markets even more worse off.
Actually, if I were to put it in 2 or 3 terms, that would be number one pointer there. The broader markets are hit much harder than your key indices, as ugly as the Nifty cut is looking. Secondly, spaces which have run up massively and where the valuation question was hovering have been hit the hardest. So if you pull up your sectoral indices, you'll see that as well. There you have the small cap 250. Yeah, so realty, metal, media, PSU banks. So if you look at this, of course, everything is hurting. So everything is in relative terms right now. The ones which have run up the highest have also been hit the highest. Even as we're talking about Indian markets, I just want to quickly pull up for you where some Asian markets closed and where Europe is right now. Because what we need to assess in the next hour or so is how deep that pain will continue. I mean, Nikkei is a mess. You have the finance minister of Japan coming and saying that we're trying to figure out what's happening. I don't know if the governor of Bank of Japan makes a statement, but 12.5% down there. Just want to pull up Europe for you right now and give you a sense of what's happening there. And, you know, it's a second day of that carnage continuing. Everything down deep in the red. Your US futures, as Niraj said, is also looking very, very weak. I just want to pull up, I mean, I don't even know if we should look at the NSE 500 gainers and losers. All right, let's pull that up to see if there are any over there to talk about. If you're looking for spots of green, they're coming into the consumption story. That at the end of the day, the Indian consumption story will continue. People will buy their toothpaste, their soaps, their shampoos, etc. Philips Carbon Black has been on a roll and a story of its own for the last several days. Cera Sanitary is doing okay. Devyani International, because if you're looking at some, discretionary spends coming in, Marico numbers were decent, Dabur, HUL. So you have those kind of stories which are doing relatively okay. On the losing side, I mean, there are just so many, too many to actually even talk about, which are hurting very, very badly in trade today. So it's going to be a broader story. It's going to be a broader sort of theme over here because, like they say, when a floating tide or a rising tide makes all boats float, when that tide turns, there are a lot of those who are exposed. And well, there is a lot of exposure in these markets today, no doubt about it. Having said that, we seem to be off the worst points of the day, Niraj, if that's any solace at all.
Yeah, is it a solace? Actually, let's ask Manpreet Gill of Standard Chartered that, because the world markets, as I said and as Tamanna said, continue to stay in a bit of a tizzy. Manpreet, great having you. Thanks for joining in. And it's a great time to have you because you look at cross assets so closely. Everyone's toying around with what the single biggest cause for this correction is. Is it US data and geopolitics? Is it geopolitical tensions? Is it yen carry trade or more? Now, tell us what your thoughts are and how extended can this be?
No, I think there's a lot of searching for what exactly triggered this. And in my mind, there are 2 factors that really are driving the sell-off we're seeing pretty much in all equity markets around the world, right? I think one is just a reassessment of where US growth is, because on Friday night, one catalyst we got was labor market data, where we saw much more weakness than markets were expecting. And when you look at the reaction, US markets, bond yields moving lower, the pricing in of Fed rate cuts, I think that's one area where there was a little bit of concern. But I think the bigger driver of what we're seeing today, especially, is an unwind of the yen carry trade. Because look, a strengthening of the yen is something we've sort of flagged concern about for some time. But the Bank of Japan sort of stands out as an exception as the only central bank that's still tightening policy when the Fed, the ECB, and most other major central banks are considering cutting rates. And what had happened is that when you look at investor positioning, we thought it was quite excessive, both on the short side on the yen and on the long side in trades like US tech. And I think the catalyst came together to really trigger an unwind of that. So in our mind, that really is a big driver behind what we're seeing. Geopolitics, yes, I think in the non-financial headlines, that's sort of the real headline. But from a financial market perspective, I'd argue that oil prices, show that that's not really the concern here. So the good news is that if this truly is unwinding led and it stays there, then those kind of moves tend to be short-lived in nature. I think the real risk we need to follow beyond the positioning unwind is obviously US labor market. I don't think that will be a cause of lasting concern when we're talking the next few days, but longer term, that's the risk I'd monitor more so than positioning, which I think we've already experienced to some degree.
Manpreet, are you saying that if and again it's an if because I don't think there is a clear answer here, but if the yen carry trade unwind is a principal reason, then it is short-lived? Then the impact may be short-lived?
Yes, because when you think about positioning-led pullbacks, right? When I say they're short-lived, they tend to be measured in weeks or perhaps even a month, which is very different from fundamental-led sell-offs, which can be more of a 6 to 12-month type challenge. I think the real difficulty today is, there's obviously that search for a bottom saying, okay, has the yen stopped where it is at 143, 144 levels? Are we going to 141? That's very, very difficult to gauge. Much better strategy is almost to wait to allow the dust to settle a little bit. I think where we can draw a little bit of encouragement is that when you look at a few other metrics like the NASDAQ, you look at US 10-year Treasury yields, or indeed the Nifty, right? We've seen pullbacks, but pullbacks that are still well within ranges we've experienced this year or within the last 12 to 18 months. So it's not that we've broken, well out of, recent trading ranges. We've just lost some of those gains in an unusually rapid or short period of time, leaving aside what's going on in Japan domestically. So to me, those sort of factors, together with the fact that going into this, we express a lot of concern more about positioning, and that then is what tends to trigger these sort of moves. To me, hard to decide whether the bottom comes today or later this week or whether it's a couple of weeks away. But those are shorter term in nature, and those tend to, usually pause at some point unless fundamentals really weaken. So that's really the lens I take.
Manpreet, hi, good afternoon. A lot of the chatter and the conversation is, are we going to see some unexpected comments from both the Bank of Japan and maybe from the Fed? Out of cycle kind of comments to calm fears. I was just wondering if you had a view on that, because the Bank of Japan decision has clearly not gone down well. We've heard from the finance minister in Japan. And do you reckon that there would be some kind of indications that central banks will want to give, that it's not as painful as it seems?
I think how central banks separate the short and long-term messages will be quite important, because where I think we're getting a lot of concern is, of course, no one would be comfortable with a 12% move in a headline index in a single day. But having said that, if we sort of just zoom out to the bigger picture, let's not forget that the Bank of Japan and Finance Ministry were also uncomfortable with the yen just getting weaker and weaker and weaker. Discomfort with volatility can be very different from discomfort with a certain level or valuation level, for example. So in terms of the messaging we get, I'd really be looking to those two messages to see how separate and distinct they are. I think that's on the Japanese side, of course. I think in the US, we do have a lot of scheduled Fed speakers through the course of this week. So there's going to be a disproportionate amount of interest and focus on what they say. I think at the last meeting, it was fairly clear that there was rising comfort with a steady sort of series of rate cuts starting later second half. I think most sort of took that to be September. The real question is whether there's anything in the labor market data that causes them to accelerate that timeline, or whether they see this as volatility, but not something that's a cause for concern in fundamentals to accelerate that. So again, trying to separate the discomfort with short-term volatility to do they see any changes in some of the longer-term fundamentals.
What about the India view, Manpreet? Obviously, we're not going to be unscathed from what's happening around the world, and the sense also to some extent that this was coming, valuations had gone up, sometimes in some stocks and sectors that really didn't deserve the kind of valuations which were coming in, frenzy, etc. Do you see a long-term impact for India? How do you gauge India in this bigger story?
Well, look, Indian markets don't operate in isolation. So what's going on elsewhere does matter. And it's a point I made on my several of my India trips that often the risks for Indian markets tend to have, come from somewhere else in the world, not domestically within Indian markets. So I think, look, on the way down, often markets sell down across the board, right? Good and bad. That's just the nature of sell-offs in every cycle. I think the distinction tends to come when you get stability and the rebound. And undoubtedly, there are pockets of froth in different parts of Indian market. But, our view, for example, has always been that, A, we favor Indian equities from a regional perspective, the overweight relative to other Asia, ex-Japan markets, because we see more sort of optimism for growth. And second, we said, look, one way to sort of navigate around those pockets of froth is to be more conservative in how you take that exposure. So we still favor large cap equities over small and mid cap, for example. So we think those messages don't really change. I think if this is, like I said, in a big picture, this is positioning led, a pullback that's across risk assets worldwide. Indian equities cannot be immune to that. That wouldn't change our fundamental view. I think it does make sense to avoid areas of froth because then you're really trading momentum, not fundamentals. So in our view, it would be more about large cap equities. It would also be about looking beyond equities. I mean, in our multi-asset view, we've taken more of a balanced view between equities and high quality bonds. And bonds have actually done pretty well as bond yields have fallen onshore as well. So those, I think, trends are still equally valid today. And I think those kind of allocation we'll be quite comfortable holding. Like I said, the real risk I'd still sort of monitor is just the US economy, because as long as that holds up in a soft landing as we expect, then we'll very well likely get through this.
One swallow doesn't make a summer. One set of jobs data perhaps doesn't bode completely towards a recession. Just one last question from my side, Manpreet, on the India story. Relatively still looks attractive. What are the spaces that you find with still some steam to give within sectors in India?
So I think from a sector perspective, obviously a few different places to look. I mean, just as an example, financials is one area where earnings are strong and obviously yields being high, should be a tailwind. But more than sort of the sector view, I think that the big sort of slice, I think might be more useful in today's context is the large versus small and mid cap. Because looking backwards, you'd argue the small mid cap were a better place to be just from a return perspective. But we think the risks are a little bit high there, right? Especially when you think of valuations and froth. We think large caps is one place we'd still look at. That's sort of one preference we take. The other one, like I said, even looking beyond equities, right? Equities may be the main source of return through a big bulk of the cycle, but what we shouldn't ignore today is the opportunity in bond yields as well. We think that still makes sense, and last couple of days helped illustrate why. So I think it's about looking across those two areas today, as opposed to necessarily looking too deeply into sectors just yet. I'd really wait for the dust to settle a bit first.
Thank you so much, Manpreet, for coming in and speaking to us. Always a pleasure. Manpreet Gill saying a few important things, and if I were to just recap the highlights out of it, what happens with the US economy is most important right now. Does that poor data sustain, which deepens recession concerns? India is looking relatively still attractive. A lot of sectors to pick from. Financials are one of those that he talked about. But you'll be hearing this term through the day and perhaps over the next few days, yen carry trade. Everyone's talking about yen carry trade and how that has really spoiled the party. Vishwanath Nair is joining us now to explain, and that's what we said, Vishy. Tell me like I'm 5. What is the yen carry trade and why are we talking about the end of the yen carry trade?
Yeah, some terrible jokes earlier in the newsroom, but I'm not going to repeat that in front of the camera. But the yen carry trade, interestingly, this is not the first time that this topic is being talked about. But what is happening now is relevant simply because what happened in the markets earlier today. So what exactly has happened in Japan and therefore in the yen? The Bank of Japan, which is the central bank in Japan, had announced a rate hike last week on Wednesday, which forced investors investors who had been borrowing actively in the yen market to change their tack. Essentially, what this rate hike meant for these traders was that the carry trades that they were conducting, it basically got erased. All the gains that they made got erased simply because the yen started strengthening. Now, what that also leads to, I mean, why exactly this yen strengthening happened was because of weaker than expected jobs data that came from the US, as well as some mixed corporate earnings over the weekend from the US. All of this led to a lot of change in tack within the yen carry trade space, and investors started pulling money out from these highly risky assets that they were making money on. Now, what exactly is the carry trade? Now, that's what we need to fully first understand. Investors go to markets like Japan, where the interest rates were at all-time lows. The currency was fairly weak in comparison to the dollar. Borrow money from these markets and then go out and invest in higher return markets, typically markets which had higher interest rates, where the currency was slightly stronger. So you would go and invest in assets in those markets, and with the differential, you would make money. Now, what these kind of carry trades allow is that these higher yielding assets basically make more money for these investors, and the opportunity cost for this entire investment is quite low. And that's why carry trades became a very, very preferred sort of mode of transaction for a lot of investors. What has prompted this? Before that, let's look at the size. So at this point in time, we don't have a fair amount of understanding of what exactly the carry trade size is, but the expectation is about hundreds of billions of dollars worth of investments have happened in high yielding assets through these funds that were raised in this carry trade fashion. Let's try and understand what exactly prompted this kind of situation in the markets. Rates have been hiked by about 35 basis points in Japan over the last 4 months, and that precisely pushed up the yen. Japan's historically negative interest rates, and also you've got about multiple years of quantitative easing by the Bank of Japan, which had led to a long period of easy money floating around in Japan, and that prompted this introduction of the yen carry trade, which became very, very popular across the world. Yen, of course, was also weak in July, just a few weeks ago, that is. In July, it had reached its lowest since 1986. So there was ample opportunity for people to play that arbitrage and make money on top of that. However, just last week, the Bank of Japan, as I said earlier, said that they're going to raise their interest rates. They're hinting at another hike later this year. So all of this pointed to a slightly more hawkish tone from the Bank of Japan. And they are also going to start with quantitative tightening, which will reduce the balance sheet size. The expectation is that their balance sheet size will reduce by about 8% through the current moves that they have announced. And then future moves will lead to further sort of reduction in the balance sheet size. Now, that's very, very important from the point of view of any kind of international investor, and they want to maybe save themselves from sudden rise in interest rates in Japan, and that's why they are unwinding these carry trades that they had invested in earlier. That means a lot of money gets pulled out of higher yielding assets, and that's probably what you were seeing in markets across the world, including India. Back to you, Tamanna.
All right, so that's why everyone's talking about what Bank of Japan did and the yen carry trade. It's simply the loss of that arbitrage opportunity that we're seeing. We're going to take a very short break, but we're coming back and talking about what you should do when market jitters are deepening. Meanwhile, if you're looking at the flash at the bottom of our screen, as I am, it is definitely a day of global crisis one way or the other. Prime Minister Sheikh Hasina is likely to resign in Bangladesh is the report coming up. Also one that she might leave the country. All that and more, and of course, sharp focus in the markets when we return. Welcome back. You have just a little over half an hour of trade in the markets today. And I mean, if you're still sticking around and being brave, kudos to you, because it's definitely looking like a rough day. Hemen Kapadia now joining us for more perspective. Hemen, I mean, do you see any signs of resilience anywhere on the charts?
Not exactly, Tamanna. I think Niraj earlier mentioned about some stocks doing the same thing, something like Hindustan Unilever and stuff. So it's just those some of the FMCG stocks which are sort of swimming against the tide. But frankly speaking, Tamanna, the laws of gravity needed to catch up. We had gone up one way. I mean, time and again, it looked we were stretched and overbought, but market just refused to correct. It needed a reason. On Friday, the US VIX went to 29.15, Tamanna. So the VIX shooting up today was also expected. And yes, I believe currently 24,100 is something which the market won't close below today. But no, nothing much. There are a couple of gaps on the daily chart, Tamanna, which are not good. They need to get covered up. And I don't think the first gap of Thursday to Friday will get covered up in a hurry. So I guess there's going to be some time and price before we see stability coming in, Tamanna.
I mean, it's a tough afternoon out there for sure. So, but the markets have fallen a bit. It looks precarious. Are trades on the short side, or are you avoiding very large trades? So, I mean, qualify that also. Even if you're taking the trades, are you taking them in measured ways in smaller quantities, or are you doing the normal quantities, if you will?
Very, very, very valid point, Niraj. Absolutely agree with you that, frankly speaking, there shouldn't be any trades. Like the earlier guest talked about the yen carry trade. I mean, these repercussions are something which you can't have normal criteria to measure. So, I mean, all these things to juxtapose, you have geopolitical, Bangla. I mean, there's so many things, so many moving parts. So, frankly speaking, in a market like this, if this is not your living, I don't think you should be even making a living in a market like this. I mean, intraday or very short-term trading. Just wait for stability to come in, wait for the US VIX to fall, wait for the Indian VIX to pull. Obviously, it won't happen that jiffy, but just wait for things to settle down. Let's see whether the support levels are working or not, and then take a stand, because currently it's still too, things are in a flux. So I would rather not do anything at all, honestly.
Hemen, I dare say ask you, what is your strategy for tomorrow and for the next half hour?
Okay, next half hour, no, but I will go out on a limb and give two stocks which come with a caveat: please don't trade. This is academic interest only. But on a lighter note, the Nifty has taken support on the 55-day exponential moving average, but a couple of stocks which are looking slightly better than the rest of the market. First one is Rosary Biotech. We've overcome the 900 level after 1.5 years. The longer term charts are looking very positive. So once again, it's a conditional buy call. Buy at 900, stop loss 850, target 1000. Once again, if you can avoid the trade, technically everything is fine. It ticks all boxes. But on a market like this, I guess everything takes a back seat. Sentiments, volatility take the front seat. And the second one, which I like, is Mahindra and Mahindra Financial Services. So the fourth wave on the monthly chart, as far as the Elliott wave is concerned, we've been consolidating over here for more than a year. Now it's beginning up. So it's not a very short-term call, but yes, one can buy it at 290, stop loss 275, target 320.
Okay. Well, I'll take that, Emin. And I take on board the point that with a caveat that one shouldn't trade. You're saying, you're still giving these ideas. Emin, very quickly before we take that break though, metals and how precarious does it look? So, you know, there were some long calls last 4 days ago on some of the aluminum or the non-ferrous side, right? Forget steel. But everything from a Vedanta, Hindalco, etc. is corrected. How much further on the charts do you see?
I'll just take 30 seconds. Firstly, if I look at the Nifty Metal Index, Niraj, it's frankly speaking been correcting for 8 weeks. So the correction has started even before the market was wobbly. International copper suddenly turned weak, and that dragged it down. And the stocks that you mentioned, I'll just briefly talk about Nalco and NMTC, and even Tata Steel. So Nalco, if you see Niraj on the charts, there's a distribution pattern rounding top. and we've stagnated for the last almost 10 weeks. So this is already there. So I would say some more pain possible.
Okay. Okay, Hemen, let's stay on. Lots more to talk about. Some more pain possible on metals, and look at the kind of falls that we've seen there. We take a quick break though on that note, on the note that it isn't getting any better. Keep on showing you what European markets and US futures are doing, of course. But on the other side, we'll try and talk about the derivative space as well, and maybe try and understand what is bucking today's trend and why so. Back with India market close right here on NDTV Profit. Let's go across to Agam, who's standing by for breaking down the derivative cues for the day today. Agam, I mean, are there some outliers or is it short build up all over?
No, certainly short build up all over. It's been a tough Monday morning and tough Monday, in fact, in general overall, especially for those who are long to the markets, because now there's a little bit of indecision of whether or not they should, in fact, move out of plenty of the stocks which were sitting on substantial gains. And, you know, to a certain extent, a lot of those gains have been wiped out, at least partially speaking. And because of that, well, there is still a little bit more trepidation as far as the bulls are concerned. For now, of course, the Nifty coming off by around 2.5%, testing 24,000. At one point in time, we did go below that mark as well. A lot of shorts being built into the system earlier, and now, well, you know, unwound to a certain extent, but and that's you know, that's a result of 2% decline in open interest. In terms of the bank Nifty, we continue to see more and more shorts building into the system for the third straight day. In fact, even as the index comes up by around 2.5% there as well. This one also tested 50,000 on the lower end. Well, and naturally, the options market will have seen a considerable sea change of you know, levels that we can keep an eye on. As you can notice, 25,000 has now completely out of the picture. 24,000 comes back, and with a lot of put writing. And as I was suggesting earlier in the morning as well, that 24,000 will be a little bit of a pivot point, if not a support level. But we're seeing a lot of puts being written there. So perhaps some traders, at least out there, are expecting the Nifty to halt its decline, at least in the near term. But when it comes to stocks, it's not been a great day, right? Because we've seen shorts in Samvadan, which is taking a knock around 9%. Vodafone Idea down 4%. PI Industries also under pressure. You have a handful of names like Marico and Dr. Lal Pathlabs advancing. Marico, of course, reacting to earnings, and the FMCG pack also doing well. India Mart also under pressure. That's down around 5%, along with Chambal Fertilizers. And Chambal Fertilizers has been so very volatile around the mark of 500. But all in all, not a great day of trade for the benchmarks, nor for stock-specific action, and that is evident in the futures and options space as well.
The only stock-specific action, I mean, let's just pull up Paras Defense, and I just saw those lines on the screen. The numbers are out, and 76% gain in revenue. Look at the spike up. I mean, if there is some sort of green shoots and hopes, the market is rewarding it. Their EBITDA has more than doubled from 11 crores to 24 crores is what I remember seeing. So good numbers in the face of it for Paras Defense. At least that stock is seeing a bit of green over there. Meanwhile, Vijay Chopra of Enoch Ventures is joining us as well on the show. Vijay, very good afternoon to you. I hope it's been a relatively good day and a decent afternoon. Tell us, what are you thinking right now about the markets, and what would you do next?
Well, I think that the satire was very good. Any person in the market, cannot enjoy this kind of redness. But, I was, Tamanna, talking about this, leave high beta, get into a low beta sector or segment of stocks. And I've been iterating it time and again. And I'm sure that you must have also, gone through my comments. So I think that, this carnage which has happened, probably we are going to see it some more because definitely markets were doing its excesses. The kind of run-up we have seen post 20,000, so there was no serious correction post the election day thing, barring that election day thing, we have not seen a serious correction, and that was also a V-shaped recovery. So I would say that this correction would make stocks healthier. So there are lots and lots of good companies which we are having on our watch list. I would rather wait and wait for the dust to settle down for a couple of days. And there are great opportunities in the I think in the public sector space, in banking, in oil and gas, in chemical space, in paints. I think that there's a lot of opportunity in the market, and definitely money will chase good companies. But yes, the froth has to be taken out very frequently, and these are one of those days where the froth has been taken out, and I would rather call it a necessity, or it was necessary for for us to see this kind of a correction. Although nobody of us, any of the market participants who are primarily long only, do not enjoy this kind of redness in the market. But I think that this would make the market healthier, and there would be a lot of opportunities to enter into fresh stocks.
Okay. So, well, that's that. Vijay, everybody was waiting for a dip in the defense names, right? High beta, of course, yes, but there is an order book out there which has to be fulfilled. That isn't changing because markets have come off. Would you use these dips or maybe further dips to buy into defense? And if so, what within defense?
Well, yes, Niraj, I think so. That defense is a sector for the next maybe 5 to 10 years. It's not 5 months or 10 months. I think that these companies the orders would keep on pouring in. India is going to become a major center for defense production, and the smaller countries are going to look up to India like we look at maybe France or US or UK and maybe Russia for certain technologies. So our companies, whether they are shipbuilding companies or aircraft building companies, or maybe companies like BEL or BEML, they have developed capacities in the last 5-10 years where they can cater to these smaller countries. They do not have such capabilities. So I would say that just wait for some more time. There might be some more crack and these companies would be, at good levels to enter. So all the companies you are showing on the screen, they would be, I would be a buyer in that. So similarly, rail companies, the kind of order book rail has, these rail companies have is also very, very interesting. So all these, Railtels and RVNLs and IRFCs and IRCTCs of the world, they are going to do well. So just wait for some time. I think they're going to come back very, very sharply. Once the market is oversold, we are going to see a major short covering as well, because nothing major has happened in India. So let me tell the audience, through your channel, that all these factors, whether it's Middle East or things happening in US or Japan, yen carry trade and all. So how much money has India received through yen carry trade? I think that it is minuscule as compared to US and Europe and other countries. So India anyway was not getting much money through yen carry trade. So it's just a knee-jerk reaction. This has become one reason for our markets to correct. Markets at times, they find reasons to correct. So this has become one reason. And I think it's good. As I said earlier, this would make our markets healthier. If there is no major political or geopolitical, no major jitters globally, I think our markets would come back. And
what is sure Vijay, one second. You're, one of those voices who are a little positive today. You're saying that when there's a pullback, our markets will come back. You're looking at rail, defense. A lot of people today have been saying those are sectors which are overheated. What do you think is going to be the trigger there? Because we're going to have to wait to see the situation clear up globally, isn't it?
Absolutely. As I said, let the dust settle down. And it's very difficult to predict, Tamanna, whether it's 1 day, 1 week, or maybe a month. I don't know. But yes, these sharp corrections would help the market in the longer run. And a lot of good companies can be entered into. Mind you that the kind of money which is pouring in through SIPs and our domestic institutions are sitting on loads of cash, and it is coming on a daily basis. So it has to be deployed. So these corrections would make good companies even better. And for sure, I'm sure that they must have exited on the top and they are waiting for entry points. So all these sectors I have talked about, these are great sectors. Just to give you an example, a company like Chennai Petro, it's a Government of India company invested by Indian Oil and Government of Iran, trading at a price to earning of around 5, huge earnings and huge order book, fantastic potential. Anyway, in the oil and gas space, which is close to a consumption space, I would rather latch on to this kind of a company. 940, 950 is a great price to get into this company. And so I'm sure that money would chase sense, because a lot of nonsense was also happening lately. And these corrections actually wake up a lot of people, even fund managers, apart from retail investors, who generally lose in such situations. But yes, these are wake-up calls and course corrections for the market.
All right. Wake-up call, course correction, a lot of ways to describe what's happening right now. Now, one sort of stand-out factor has also been how the defensive play has strengthened. If you look at a heat map of the Nifty right now, you will see FMCG stocks standing out in trade today. Various reasons for it. Let's pull up a heat map of the Nifty, and you will see FMCG stocks standing out. And one of the reasons is also results. In some cases, it's a defensive play as well. Mahima is joining us with more. Yes, Mahima.
Right, Tamanna. So as you rightly mentioned, a lot of these FMCG names are, bucking the trade today, and this is because, it's the defensive play that's taking place now. Couple of things which have also aided growth for this FMCG stocks is that there's been significant recovery in the rural demand, and overall margin expansions for a lot of these names have taken place. Now, Britannia particularly is buzzing on the back of its Q1 FY25 earnings, which came out Friday post-markets, where numbers are largely in line. Margins were slightly below the estimates. Net profits were also slightly below the estimates. However, the volume growth was around 8%. Value versus volume was around 6%. And for Britannia as well, the rural demand outpaced the overall urban demand, and they continue to target 2% cost efficiencies every year is what the management has guided today in their con call, and they've said that they might further take price hikes of 4 to 5% if the raw material prices keep rising. Now Marico is also buzzing in trade on the back of its Q1 earnings which were announced today. Numbers were largely in line in terms of net profit. It grew around 8.7%, and its margins have also expanded a tad bit. Now, key highlights: volume growth of around 4%. The numbers were largely in line, like I said, and India sales growth was around 7.4%, and international sales growth was nearly 5%. However, the management has given their outlook in their investor presentation, and they've said that overall food portfolio will be 2 times by FY27. They've said that they aim for a double-digit EBITDA margin for the digital-first brands by FY27, and overall foods and premium care is expected to rise by 25% by FY27. And overall, they've also said that they expect to retain double-digit constant currency growth going forward. Now, other couple of FMCG names which are also buzzing in trade today include HUL, Nestle, Dabur, Tata Consumer, as well as Godrej Consumers.
Okay, thank you for that, Mahima. Let me go across to Hemant and get his view on any of these stocks. I mean, obviously a defensive play. We saw this right after the budget as well. We saw this right after the election result as well, where these come in for a sort of bit of interest. Do you see that sustaining on the charts, Hemant?
Yes, I think if you look at the Nifty FMCG index we posted all-time high last week, and we are slightly but not comparatively very far away from the high. And the interesting one is Hindustan Unilever, Tamanna. We've been here for what? 4 years. 4 years. It's in a very, very large range. 1850 on the downside and 2850 on the upside. So that's 1,000 points. And for 4 years, we've gone nowhere. Obviously, there have been bounces on both sides. So if and when we take out this 2850 range, I think it's going to be the beginning of a bigger move. So still looks good. And selectively, yes, I think many of even Godrej Consumer, many of these FMCG stocks are even, something like a Dabur moved and has consolidated. But Dabur, Tamanna, has been here for 3 years. A breakout about 660 is going to take it past 800. So many of these stocks have taken years in a thriving bull market. I think their time for the place in the sun is coming.
Is coming. Vijay, do you think so? That time is coming now for the FMCG stock, which have really sat it out in this bull run, isn't it?
Well, there has been a long consolidation. Look at a stock like Britannia, ITC. Hemant mentioned about Marico, Dabur. So these are all behemoths. You open your closet, I'm sure that you will find 10 products which are from Hindustan Lever or Colgate or maybe ITC. So any closet in the country for that matter, whether it's rural or urban or semi-urban, you'll find all these FMCG company products. So why these are not moving? So one reason could be that, the per capita income is not increasing. People are not having that kind of disposable incomes. But yes, I think that, post consolidation, I suppose that, there is a lot of potential. Maybe, a stock like ITC, I see ITC at maybe 800 or 1000. So this is my target for ITC, but it has been consolidating in that range for a long time. So I would be a buyer in ITC if I get it around 460, 450. These are great levels to get into an ITC with a longer term perspective. Similarly, Hindustan Lever, Britannia, Nestle. Look at a Nestle, it hasn't moved much. But again, it's a global behemoth. And I think that, Nestle can easily go up to maybe 3,000, 3,300.
Okay. Well, amongst other things, while there is carnage across the street, Airtel is not spared from it either, and it's set to report its first quarter numbers. Let's get in Rucha to talk about what is it that one should watch out for when it comes to Airtel's numbers. Rucha, good afternoon.
Good afternoon. Thanks, Niraj. So Airtel will report its numbers post-market. Now, talking about the numbers, revenue is expected to ride around mid-single digits, around 4%, while margin is expected to remain flat at just a little bit of uptick at 26.5% versus around 25% in the previous quarter. The net profit is expected to rise around 24%, but this is after adjusting the one time that the company had in the previous quarter. Now, the company had an exceptional items in the fourth quarter, but if we look at the India business will be the key thing to watch out for, because the Africa business has already reported numbers. Talking about the Africa business were reported weak margins, and the performance was largely impacted due to a currency hit because of the devaluation of the currency. The mobile segment, however, continued to see good traction, and this is what we will see in the India business also when the company reports its numbers today. Also, the subscriber addition and the conversion of 2G customers to 4G is what is to be watched out for in the results today.
So Bharti Airtel, I don't know if by tomorrow it will be business as usual, and tomorrow morning we'll be talking about Bharti Airtel numbers and seeing their ARPU, etc. Or it will be another day of pain, possibly one more day of pain that you could see, considering what we have seen across the globe and that, completely continuing. But when sanity returns, sooner or later, yeah. I mean, I'm wondering if a Bharti Airtel is something that you would have on your radar?
Yes, but it's sort of corrected by going upwards. The oscillators seem to indicate a little bit of heaviness. I'd be more comfortable buying this closer to 1400, Tamanna.
Okay, by the way, some flashes on your screen, and Honeywell seems to have done okay. I mean, I don't know if they were estimates, but broadly on the margin front, they seem to have certainly done a lot better. And it's showing, it won't show up in the stock price move. I mean, yes, a bit of a flash here and there, but that's a trading flash really. But good numbers, net profit up 33%. Remember, much like ABB and Siemens, it's an expensive stock, but doing okay, Honeywell, or at least on the quarter. The revenue growth could have been better for an automation company. And I think you will see the chalk and cheese between Honeywell and maybe an ABB. I may be wrong, but I think I won't be, based on the estimates that I've seen for ABB as well. The top line difference might be the reason why the markets have taken such a liking to an ABB or a Siemens or some others versus maybe a Honeywell automation. So bear that in mind. But expensive stocks, all of them have to be kept in mind. Speaking of expensive and speaking of markets, we spoke earlier to Vinay Jaising, and he spoke about how while markets have been anticipating a rate cut for a while, the latest Fed decision actually hinted at a cut in September, and whether these rates cuts have been priced in or no by investors is what we asked Vinay Jaising of JM Financial. Listen to a small slice of that conversation.
So, yes. So, I think if you look at the 10-year chart, it's exactly what you're saying, which is, close to 4%. So 5.25 is already being factored in the bond market of having a cut of as much as 100 to 125 basis points. 3 months to 4 months, we don't need to be as cute as whether, you get 125 in 3 months or 125 basis points in 4 to 5 months. But, I think that will become consensus. Remember, 6 months ago, we were talking about 7 cuts and even more aggressive cuts coming in totality. I think that's behind you. Probably a 6 month forward comment of 4% interest rate in US for 10 years as well as a 4% interest rate for Fed of 4 to 4.25 is a lot more real. Now, when that happens for the first couple of months, my bet is people will realize why that has happened, which is, you're seeing delinquencies and mortgage rates, you're seeing credit cards, payment problems happening from the retail customer. You're seeing capex slow down in US. And when you see all these things getting added up, the market will probably, short-term correct before they realize, guess what, the cost of capital is going down, which is good news for the market. But that, I think, will be 3 to 6 months forward. So 6 months forward, you'll probably see the market a lot more stable to moving up. But in the next 3 months, I see a lot of volatility in the global markets.
Okay, now meanwhile, while we're talking about volatility in global markets, there's volatility in global politics also. A story that is unfolding right as we speak is in neighboring Bangladesh, where Prime Minister Sheikh Hasina and her sister have reportedly fled the country and taken shelter in India. This is after hundreds of thousands of protesters demanded she resign amidst a deadly anti-government stir. We're getting news from local reports. These reports also suggest that the Bangladesh Army chief is in talks with various political parties and stakeholders. A lot of turmoil there in the neighborhood. That footage coming in of Sheikh Hasina actually exiting. There's some reports that her residence was stormed by protesters. These protests have been going on for a while in Bangladesh. I saw newsflash, Niraj, that the LIC offices locally in Bangladesh have also been shut for now. And these are anti-reservation protests which were going on for a while, and they seem to have completely spiraled out of control. You might see Sheikh Hasina landing in India sometime soon.
Yeah, and some of those earlier footages as well, or visuals of students, groups fighting against each other with stone pelting, etc. Were very, very scary. So big political development right in our neighborhood, and which is why this has that little bit of an importance. Okay, last 9 minutes of trade left. Let's try and take in closing strategies. I mean, you started off giving us your ideas this afternoon by saying that people shouldn't trade, but there's 9 minutes left or 8 minutes left. If you had to take a trade right now as a closing strategy, would you take one? And if so, what would that be?
Well, Niraj, if you don't put a gun to my head, I'll still say the same thing. Please don't take a trade. And if you put a gun to my head, then I'd say maybe you can do something on a LTA Mindtree. A bounce is coming, but it's still too raw. The gashes are not yet getting covered up. Tomorrow we might see a slightly lower bottom before we see stability. So I'd say don't trade.
Okay, don't. Vijay, you kind of do both techno and funda. If you were to wear the hat of somebody who's a chartist and think of a trade, would you take one right now? It could be a short trade too, by the way.
Well, shorting at these levels, I would say that
no.
I won't prefer. But I said, BTST and all, I'm not that intelligent to comment on things like that. But I chase value. And I think a stock like Chennai Petro, as I mentioned, I would latch on to it at these levels even. And I think that it can easily go up to 1200, 1300. So 930, 35 is a great level to get into this kind of a stock, which has deep, deep value. Government of India company, no problem at all in buying such a company.
Mm-hmm. Okay. A winner of Friday's trade was Zomato. Big move there. In today's session, at least at the first half of trade, Zomato fared much better, and even right now, it's faring much better than what the rest of the universe is, if you will. Hemant, if you were a tactical or a positional trader in Zomato who bought in sub 200, currently, would you take money off the table, or would you believe the charts are strong enough for you to stay invested?
Standalone Zomato doesn't look bad, Niraj. What you mentioned on Friday, the outperformance or the resilience is very much apparent. And I don't think one day of a bad market changes it. My only, I wouldn't say a problem, but a slight point of concern is there's an upward gap between Thursday and Friday. Markets and stocks have a tendency, I'm not saying it's a benchmark or a ground rule, but I think out of 10 times, 7 to 8 times, markets and stocks have a tendency, or at least have it in their nature to try to cover up the gap. Maybe it doesn't get covered up with a bullish gap, I'd be more happy. There is a bullish gap between 243 Niraj and 238. So if I were to say this gap might get covered up, but otherwise no evidence except the overall market condition that Zomato is weak. On all time frames, it remains stoic and strong.
Well, very, very, very strong is Zomato. You have to use the term very simply, because on a day like this, wherein only pure defensives have found favor, here is Zomato, which is seemingly doing okay. Just 2% lower is not too bad at all. But FMCG have ruled the roost today, so and naturally so not bad there. Just one quick thing, Vijay Chopra again it could be a chart call, but life insurance firms, the other ones which have done very well the whole of July and balancing out, not doing that badly today.
Well, yes, I think that LIC followed by HDFC Life would be my preferred picks. But again, I would very strongly recommend don't just jump and buy. Let the dust settle down. I like LIC a lot, so it has corrected also, and if at all you can even get it at a lower price, it would be a great buy around 1050.
Okay. Well, so that's the strong recommendation on those as well. And before we wrap up the show, Hemant, one final question to you. Which of the FMCG charts look strong? And again, we are doing this conversations from a perspective of the fact that the retail investor is not under compulsion to invest his cash like a fund would be, because it doesn't have to beat the benchmark per se. So that goes without saying. But be that as it may, for somebody who's got the itch to trade and looking at FMCG strength currently, Hemant, is there a trade there, or would you leave it alone?
No, there is a trade, but it's a positional investment sort of a trade, Niraj. Strongest is Godrej Consumer, but since it's already moved, I would not want to chase it now. Two stocks which have the propensity and the capacity to surprise. First one is Hindustan Unilever, which we spoke about, Niraj. It could very well, after 4 years, if the stock moves, it's not going to be 3 months, it's going to be 1 or 1.5 years, or maybe even 2 years of an up move. And Godrej, it's taken 3 years. Dabur. So it's a toss-up between Hindustan Unilever and Dabur. So on decline. So I'd say split money equally between both. Once again, time frame is 12 months or more.
Hemant, what about some of your discretionary players in this space? I mean, Niraj spoke about Zomato, but if you look at a Sapphire, let's even look at platform company like Delivery, etc. Do you think that if we are going to take that consumption theme forward, you could see opportunity here?
Yes, I think something like a Delivery has been strange, Tamanna. We've spent almost 2 years, and we've gone nowhere. But normally when there's such a protracted period of inactivity, the follow-up after that can be surprisingly positive. So I would say, yes, that isn't exactly a bad idea, honestly speaking, but we'll need some little bit of time and price confirmation to be honest. Yeah.
Okay, gentlemen, we'll leave it at that. Thanks so much for taking the time out and being with us. About a minute and a half left for the markets to shut shop. I mean, not too much has changed because the Nifty is still about 2.7% lower. So mind you, any hopes of a pullback, a close just below 2% are all dashed, because we are still as precariously placed, and even for the banks has not looked too good. Save for FMCG, frankly, nothing else, as ITs look very, very choppy. And just the heat map, I mean, those 4 or 5 names, just 4 names in the green, and a lot of stocks under some serious cuts in the session today. No points for speaking about a name or two, because from an Adani Enterprises to a L&T to a Reliance to a Titan to HDFC Bank to Infosys, Tamanna, everything under pressure. I'm not even talking about the top 5 losers currently.
Yeah, I'm a little astonished at the extent of the gash in Tata Motors. Like, everything is relative, as you're saying, but because of Maruti, 4% down is not that bad. Auto, if I were to mark out, is one of the big losers. Samvartana, look at that, top loser on the Nifty 500 as well. Should we look at the advanced decline ratios to see if there's any green at all? And also tells you the extent of the carnage. Look at that. A yawning gap there, which has stayed steady through the day. 143 advances to 1973 declines. I mean, there's no question. I don't know if there's anyone who has been brave enough to buy in this market today. Possibly not. In terms of what has hurt the most, we'll just pull up the sectoral indices for you very, very quickly and go through that. You are going to be seeing, the metals have deepened and moved to the bottom of the barrel as we've come into close. It was the realty stocks through the day, Niraj, but it's come down to the metals, and that's reinforcing the number one factor as being not just what the Bank of Japan has done, but those recession fears. Because we're going to go into a place where you have tepid demand, then this is looking iffy. I think just quickly the NSE 500 to see if there's enough of green to talk about. Yeah, just where we started. Cera Sanitary has done okay. Over here, you have a whole host of companies which have done very, very badly. Thermax also feeling the pain. Borosil Renew there, Adani Energy, some of those which are truly feeling the pain. I think another rough day perhaps tomorrow, at least. We'll have to wait and see if things get worse before they get better, but they'll definitely be as bad. What should you do in a market like this? We have a comprehensive set of stories and coverage for you all through the day. So while this is it from Niraj, me and the team that put the show together, do stay tuned. A lot more coming up on NDTV Profit.